Welcome to The Explainer. I am so incredibly excited you're here today because we are tackling something that is literally on every taxpayer's mind right now. We're currently right in the middle of a massive historic transition, moving from the Legacy Income Tax Act of 1961 all the way over to the brand new Income Tax Act of 2025. And more importantly, we're going to break down exactly what this means for you as we quickly approach the absolutely critical August 31st filing deadline. If you've been feeling a little anxious about which rules apply to which income, or just how to manage this upcoming filing season without making a super costly mistake, trust me, you are not alone. We're going to unpack exactly what the official guidelines say, straight from the source, so you can make this transition completely seamless.
Okay, let's dive into this. Here's our roadmap for today. We'll be looking at 1. The new tax acts transition. 2. Navigating the two acts. 3. Critical dates and deadlines, especially that huge August 31st cutoff. 4. Fixing mistakes and revisions. 5. Carrying forward your losses. And finally, 6. Tips for smooth filing. Let's kick things off with Part 1, the new Tax Act transition, where we look at replacing 1961 with 2025.
So, looking at this transition, the absolute biggest question popping up everywhere is this: which tax act actually applies to your income this year? It sounds like a pretty simple question, right? But since the new act officially comes into force on April 1, 2026, it creates this really unique crossover period. You might be sitting there wondering, am I filing under the old rules or the new rules right now? Do I have to file two separate returns? Let's clear this up immediately.
First off, don't panic. The fundamental structure, things like mandatory filing, due dates, and the specific categories of people obligated to file remains exactly the same. Under the new act, the provisions for filing are all neatly packed into Section 263. This one single section handles the whole shebang: your original return, belated returns, revised returns, and updated returns. It essentially mirrors the old mandatory filing rules completely. So while the law itself is getting a massive overhaul, the basic everyday mechanics of who needs to file haven't been turned completely upside down.
Moving right along to Part 2, navigating the two acts, effectively acting as a comparative bridge.
Now, what's really interesting here is how the source material separates our timeline into two totally distinct realities. On one side, we have the old world, the Income Tax Act of 1961. This governs assessment year 2026-27, which is the income you actually earned during the financial year 2025-26. Even though you are physically going to file this return after the new act takes effect on April 1, 2026, you are still entirely governed by the old 1961 Act. Make sense? Then on the other side, we have the new world, the Income Tax Act of 2025. This governs what is now being called tax year 2026-27, representing income earned during financial year 2026-27. You won't actually file for the new world until July 2027. So for your immediate upcoming deadlines, you are strictly applying the old rules.
Which brings us perfectly to Part 3, critical dates and deadlines. It's time to mark your calendars, folks.
These dates are absolutely everything. April 1st, 2026 is when the new act officially comes into force. But remember, for your upcoming filings, we are still looking at the old rules. July 31st, 2026 is your standard filing deadline. But the date to really circle in thick red ink is August 31st, 2026. This is the crucial filing deadline for non-audit cases. If you fall into this category, August 31st is your absolute target. You literally cannot miss this. And for those of you wondering about the technology side, don't worry. The e-filing portal is being updated to support compliances under both acts at the exact same time. You'll just select Assessment Year 2026-27 to use the old ITR forms, which are going to be available well before these due dates. But seriously, make that August 31st date your top priority.
Let's jump into Part 4, fixing mistakes and revisions. What actually happens if you miss that August 31st deadline, or if you just make a typo on your form?
Well, if you miss that due date, this 5,000 rupee figure comes into play. Under Section 234F of the old Act, which, remember, still applies to your assessment year 2026-27 filings, this is the maximum late fee for a delayed return. Now, there is a tiny silver lining here. That fee drops to 1,000 rupees if your total income doesn't exceed 500,000. But honestly, this is exactly why hitting your respective July 31st or August 31st deadline is so essential. Paying taxes is painful enough, right? You absolutely don't want to be handing over extra money on late fees just because the new act transition caused a little confusion.
Now, what if you do file on time by August 31st, but realize, say a year later, that you completely missed some additional income? You have a safety net called the Updated Return, or ITRU. This provision allows you to file an update within 48 months from the end of the financial year. Under the new Act, this is found in Section 263(6), and under the old Act, it's 139(80)(a). The truly beautiful thing about this transition is that even if you discover an error for assessment year 2026-27 way down the line in 2028, you can still file your updated return completely under the old 1961 Act rules. The fact that the new Act is legally in force doesn't matter. The old Act governs its own years perfectly.
All right, let's pivot to Part 5, carrying forward your losses. This one is incredibly important for any business owners, freelancers, or investors out there.
Many taxpayers have been terrified that the new 2025 Act is just going to wipe out their unabsorbed losses from previous years entirely. But the source material has a very reassuring line for this. Section 536(2)(b) protects rights acquired under the old Act. This brilliantly illustrates the government's intention to make this a genuinely smooth transition. Let's say you had an unabsorbed business loss from assessment year 2022-23 and it's been carrying forward. This transition does not interrupt or reset that clock. Losses determined for AY 2026-27 under the old Act can be seamlessly carried forward and set off in the new tax year 2026-27 and beyond, following the exact same conditions.
But listen up, because there is a massive catch. You must file your return of loss within the due date to carry it forward. So that August 31st deadline for non-audit cases? It isn't just about avoiding a 5,000 rupee penalty. It is quite literally about protecting your legal right to carry your losses forward into the future. If you miss the due date prescribed under the old Section 139(1), which corresponds to the new Section 263(1), you forfeit the right to carry forward losses for business, racehorses, or capital gains. Hitting your deadline is absolutely non-negotiable if you want to utilize those losses in the new tax regime.
Let's wrap this all up with Part 6, Tips for Smooth Filing. How do we take all this dense information and actually put it into practice?
Consider this your ultimate survival guide for the transition year. For starters, you need to maintain a really strict demarcation of your income, expenses, TDS, and advanced tax between FY 25-26, which is the old Act, and FY 26-27, which is the new Act. Treat them like two entirely different financial universes. It's also critical to double-check your challans, ensuring they correctly reflect assessment year 2026-27 for the old regime or tax year 2026-27 for the new one. Make sure you reconcile your Form 26AS separately for each year. Keeping a quick section mapping reference handy will also save you massive headaches. Just knowing that the old Section 139 is now Section 263 goes a long way. And finally, please, file well before your due date. If your deadline is August 31st, do not wait until August 30th. The e-filing portal is managing a dual-track system for the first time ever, so give yourself plenty of buffer time to avoid any weird technical glitches.
Which leaves us with this final, vital question to think about. As that August 31st deadline rapidly approaches, are your financial records clearly split to handle both the old and new tax regimes? This transition year is undeniably historic, but it really doesn't have to be overwhelming. By understanding that your upcoming returns are still fully governed by the old Act, by protecting your carry-forward losses by filing right on time, and by strictly separating your records, you can navigate this bridge year with total confidence. Get those records in order, lock in on that August 31st date, and take control of your financial transition. Thank you so much for joining me on this explainer today, and happy filing.